Forget everything you learned in Economics 101. The invisible hand just got slapped by the White House. If you're trading today, you're not just fighting the tape, you're fighting the executive branch. Yesterday, we got word of two massive interventions that rewrite the playbook for 2026. First, a plan to seize control of Venezuelan oil to force prices down to $50 a barrel. Second, a direct order to buy $200 billion in mortgage bonds to crush interest rates. And just for a cherry on top, Intel is getting the presidential seal of approval, and NVIDIA chips are flowing to China again for a price. The conflict today isn't bulls versus bears. It's government intervention versus market reality. Can the White House brute force a Goldilocks economy without breaking the U.S. shale industry or reigniting inflation? This is the pre-market pulse. Let's follow the money. Deep Dive 1. The Venezuela Gambit. Let's start with the biggest story on the board. The Wall Street Journal dropped a bombshell report last night. The Trump administration is planning a sweeping initiative to dominate Venezuela's oil industry. Here's the headline number you need to tattoo on your trading desk: 50 per barrel. That is the president's target price for oil. The plan involves the U.S. exerting control over PDVSA, that's Venezuela's state-owned oil giant, and handling the marketing of their crude directly. Why does this matter? Because Energy Secretary Wright believes the U.S. can pump Venezuela's output by 1.2 million barrels per day in the next 18 months. Now connect the dots. Who benefits? The administration is explicitly looking at Chevron, CVX, to lead the charge, with Exxon, XOM, and ConocoPhillips, COP, playing constructive roles. If you're holding these majors, you're looking at access to the largest proven reserves in the Western Hemisphere, potentially backed by U.S. security guarantees. But here's the conflict. 50 oil is a kill shot for U.S. shale. Most analysts, and the folks at Ritterbusch, warn that 50 is the threshold where drilling becomes unprofitable for many American companies. A sustained period at that price could decimate the U.S. shale industry. So we have a paradox. The administration wants energy dominance, but its price target could bankrupt domestic producers. Ironically, crude futures jumped 3% yesterday to around 57. Why? Because traders looked at the inventory draw, which was larger than expected, and decided the Venezuelan supply flood is still years away. The takeaway: the market is betting this supply takes time. But the policy intent is clear. Avoid high-cost shale explorers, XOP, and stick to the majors, CVX, who have the invite to Caracas. Deep Dive 2. The Macro, Shadow, QE, and Housing. From the oil fields to the suburbs. The second arm of this command economy strategy is hitting the housing market. President Trump has directed representatives to buy $200 billion in mortgage bonds. Let me translate this for you. When you buy mortgage-backed securities, MBS, in bulk, you drive the price up and the yield down. Mortgage rates are tied to these yields. This is an attempt to artificially narrow the spread, the gap between Treasury yields and mortgage rates, to lower borrowing costs for homebuyers. Basically, the government is trying to do what the Federal Reserve usually does, quantitative easing, but through a side door. This aligns perfectly with what we heard from Treasury Secretary Scott Bessent yesterday. He argues current rates are substantially above the neutral rate and is pushing for the Fed to cut by another 100 basis points. So who wins? Home builders. ITB lower rates mean more buyers. It's that simple. Fannie, FNMA, and Freddie, FMCC, these stocks are going ballistic. Trump stated he chose not to sell them in his first term, claiming they are now worth an absolute fortune and holding $200 billion in cash. Rumors of an IPO for these two giants are heating up again, with a decision likely in a month or two. The conflict: this is massive liquidity injection. While it helps housing, ITB, it creates inflationary pressure. If you're long bonds, TLT, watch out. The government buying bonds supports prices now, but if this reignites inflation, yields will rip higher later. The silent mover, the mining supermerger. While everyone is distracted by oil and mortgages, the tectonic plates of the materials sector are shifting. We are looking at a potential supermerger. Glencore, GLCNF, and Rio Tinto, Rio, have restarted talks. We're talking about a combination that could create the world's ultimate commodities titan. Why now? It's about copper and the energy transition. But there is a silent mover inside this story that you need to watch. Silv. Goldman Sachs just issued a warning. Expect extreme price swings in silver this year. Why? 2 reasons. The London squeeze. Silver inventories in London vaults are unusually low because metal was moved to the U.S. to dodge potential tariffs. China. New export restrictions from Beijing require official approval for silver shipments, fragmenting the market. Goldman says the market is so tight that a small increase in demand creates a massive price spike. Sensitivity has surged from 2% to 7%. The play. If you're playing the reflation trade, don't just look at gold. Silver, SLV, and the miners, Estelle, are coiled springs right now. And if Rio and Glencore merge, the valuation of every miner with copper and silver exposure gets re-rated upwards. We've got 90 seconds. 3 tickers. Bullish or bearish. Let's go. Intel, INTC. Host. Verdict bullish. President Trump just had a great meeting with the CEO and bragged about their new sub-2 nanometer chips. The U.S. government owns almost 10% of this company now. It is too big to fail, and now it's effectively state-backed. The turnaround is political, not just technical. Soho House, SHCO, host, verdict bearish. The private club is getting clubbed. They disclosed a $200 million funding gap for their sale because the buyer, MCR, can't cough up the cash. The stock plunged 11%. Never catch a falling knife when the financing falls through. Stay away. Air Test Systems, AHR, host, verdict, bullish. This is your picks and shovels play for AI. They just reinstated fiscal 2026 guidance and are forecasting bookings to double in the second half. They are testing the chips that run the AI data centers. The stock took a hit on earnings, but the forward guidance says the AI demand wave is hitting their order book now. All right, here's your playbook for tomorrow, Friday the 9th. It all comes down to 8:30 a.m. The employment situation report drops. The consensus, 55,000 payrolls added, unemployment flat at 4.6%. The trap, if the number is too hot, yields, US 10Y, spike, and that $200 billion housing intervention gets harder to execute. If it's weak, the Trump put gets even stronger. Also, keep an eye on China. Inflation data just came in. CPI is basically stagnant at 0.8%. Deflation is still the dragon they can't slay. This means China needs to export, which puts them on a collision course with U.S. tariffs. Trade careful, watch the oil headlines, and don't fight the White House. This is the pre-market pulse. I'll see you on the other side of the bell.